Recently, reports revealed that Bridgewater Associates, the world's largest hedge fund, sold all of its holdings in U.S.-listed Chinese companies during the second quarter. This move signaled the fund's complete withdrawal from Chinese stocks and highlighted the deepening financial rivalry between the U.S. and China. According to filings with the U.S. Securities and Exchange Commission, Bridgewater exited 16 positions in Chinese companies, worth a total of $1.41 billion. These included major names such as Alibaba, JD.com, Pinduoduo, Baidu, NIO, Trip.com, and Yum China. Other sales included Tal Education, Huazhu Hotels, KE Holdings, and Autohome, marking the first time in years that Bridgewater erased all direct holdings of U.S.-listed Chinese stocks. This shift came as a surprise. In recent quarters, Bridgewater had been reducing its U.S. stock positions and heavily buying Chinese stocks. In fact, during the first quarter, it increased its holdings in Alibaba from $21.6 million at the end of 2024 to nearly $750 million, a jump of more than 3,360%. But the reversal happened as markets grew volatile and investors became more cautious. In the second quarter, renewed tariff tensions between the U.S. and China triggered sharp pullbacks in both markets. Bridgewater, founded by veteran investor Ray Dalio, had long viewed China as a key part of its global diversification strategy. Yet under today's trade tension, the firm appears to be reassessing its risks. The hedge fund has shifted its focus to U.S. tech giants. It boosted its stake in NVIDIA by 154%, raising the stock to 4.6% of its portfolio. It also increased its holdings in Microsoft by 112%, Alphabet by 84%, and Meta Platforms by 90%. By June 30th, Bridgewater disclosed it held 585 publicly traded stocks worth $24.8 billion, up from $21.6 billion 3 months earlier. These holdings are part of the firm's $136.5 billion global asset management scale. The filings also showed Bridgewater exited indirect Chinese investments by selling its positions in ETFs such as the iShares MSCI China ETF and iShares China Large Cap ETF. This pointed to a broader strategic pullback from China. Analyst Mr. Z explained that Bridgewater, founded in 1991, is the world's largest hedge fund. Unlike aggressive funds like Quantum or Tiger, its style is relatively balanced and conservative, with a focus on macroeconomic trends and long-term investments in high-growth regions. Over its 30 years of growth, Bridgewater has created multiple financial instruments and has been honored several times as the world's best bond manager and top fund management company. During the 2008 global financial crisis, Bridgewater Associates performed exceptionally well, with its strategy allowing investors to avoid the fallout of the collapsing stock market. However, this strategy did not succeed in 2009, when economic growth picked up faster than expected, and the Dow Jones Industrial Average rose by 19%. At that time, Bridgewater's Pure Alpha Fund reportedly only gained 2% to 4%. Following this, Bridgewater turned its attention to China, and over the next decade benefited greatly from China's rapid economic growth. It became known as one of the strongest supporters of U.S.-listed Chinese stocks. In 2011, Bridgewater established a representative office in Beijing. In March 2016, Bridgewater's wholly owned subsidiary, China Investment Management Company, was established in Shanghai and received a license for the Chinese Interbank Bond Market, CIBM. By 2018, Bridgewater China had obtained a private fund manager license and launched its first domestic private fund, the All-Weather No. 1 Fund. By 2021, Bridgewater China's managed domestic private funds had exceeded 10 billion RMB, making it the largest foreign private fund manager in China. Founder Ray Dalio left Bridgewater in August this year, selling his shares and resigning from the board, stepping away from the company's governance and ownership structure. Mr. Z pointed out that due to vested interests, Dalio had often defended investments in mainland Chinese companies. In April of this year, he called for a rebalancing between the U.S. and China and urged both sides to reach an agreement to significantly reduce imbalances. This was entirely consistent with Bridgewater's actions in the first quarter of the year, when it heavily increased its holdings in Chinese stocks. Dalio's strategy of heavily investing in Chinese stocks during the first quarter was based on the expectation that the U.S. and China would reach a tariff agreement in the second quarter. With this positive development, the blue-chip Chinese stocks in his portfolio were expected to rebound significantly. This was a classic high-leverage short-term strategy with high risks, almost akin to a gamble. However, as we saw, the tariff war did not end but entered a new phase. Along with historical tariffs, the US imposed an effective tax rate of 55% on China, the highest in the world. As a result, Chinese stocks performed poorly and fell far short of expectations. Yet this outcome may not have surprised Dalio too much, as he had already delivered a shocking speech on China's economy last year. On March 27th last year, Dalio posted on LinkedIn, stating that Beijing was currently overshadowed by the accumulated burdens of the past 40 years. He wrote, "When there's a lot of debt and big wealth gaps at the same time as there are great domestic and international power conflicts, great disruptive changes in nature like droughts, floods, and pandemics, which China is especially prone to, and great changes in technology, there's an increased likelihood of a 100-year big storm. That is the current environment in China." The article mentions that around 2014, foreign investors believed that under Xi Jinping's leadership, China's transparency would improve, making it easier for large foreign investment institutions to operate. However, now, foreign investors' enthusiasm for China has waned. Dalio believes that China should have directed its resources, attention, and energy towards broader developmental needs, but these were neglected due to excessive credit. He warned, when debt becomes unpayable and the wealth gap widens, the cycle linking credit creation to purchasing power and the prosperity of capitalism will start to reverse. The article also mentions that Xi Jinping had boasted in front of U.S. corporate leaders that China's economy was healthy and sustainable. However, Dalio does not believe that China can easily generate a virtuous economic cycle again. He wrote, "No one knows how far the pendulum will swing towards the more Maoist, Marxist ways of doing things. The absence of clear communication from the leadership about the motivations behind their actions and where they're headed is leading to greater amounts of imaginary speculation than there would be if there were clearer communication." In the article, Dalio listed China's 5 major challenges. 1. The debt issue. In recent years, China has been deeply mired in a real estate crisis. Property prices and employment have spiraled down, severely affecting China's economic development. Moreover, China's long-term one-child policy has led to an aging population, putting immense pressure on the financial system. Dalio stated that these problems will put pressure on economic activities, prices, and sentiment. 2. Wealth inequality. Dalio noted that due to severe wealth inequality, the Chinese government has started promoting common prosperity. He believes that this policy will generate fear and further worsen the psychological mood within China. 3. Geopolitics. In recent years, relations between China and the U.S. have deteriorated, and the rivalry between these two superpowers is affecting investor confidence, prompting them to move funds out of China. Businesses are caught in the middle of this relationship. Dalio wrote, "In trade and capital flows, a cat-and-mouse game has developed that has led companies and people to move to neutral countries and to try to appear to be non-Chinese or not Chinese sympathizers, so much so that the Chinese are having problems getting other countries and companies to accept them being there and or investing in them." 4. Technology challenge. In recent years, the U.S. has imposed export controls on high-tech products to China, especially to prevent advanced chips and technologies developed by U.S. companies from reaching the Chinese military. Dalio pointed out that Beijing is facing a tech war initiated by the U.S. Both governments are investing heavily in developing high-tech industries, such as artificial intelligence and quantum computing, with both countries aiming to lead in these fields. 5. Climate change crisis. In addition to the 4 major challenges mentioned above, China also faces a climate change crisis. Floods, droughts, and pandemics would cause significant losses. Some commentators believe that Dalio, who claims to be a lover of China, is very popular among Chinese investors. He has spent a long time building close relationships with relevant officials in the Chinese government. Because of his enthusiastic support for China, Dalio has even been criticized by U.S. politicians. So when Dalio warned that the largest economy in Asia would face a once-in-a-century storm, people had no choice but to take him seriously. Mr. Z noted that Bridgewater Associates is an important investment partner for many U.S. pension funds. The reason Bridgewater cleared out its Chinese stock holdings is not just due to serious issues in China's economy, but also because of its overly close relationship with the Chinese Communist Party, which has led to accusations that the firm is helping the CCP siphon off U.S. retirees' savings. In April 2024, a U.S. congressional investigation revealed that Wall Street used billions of U.S. retirement funds and other investments to purchase stocks in index funds, including 63 Chinese companies with links to the People's Liberation Army. The blacklist of Chinese companies receiving U.S. investments include aerospace giant China Aviation Industry Corporation, which manufactures planes for the PLA, Daqo New Energy, which uses forced Uyghur labor in Xinjiang, BGI Group, and the cybersecurity company Qihu 360. The committee's report stated, "What may surprise many Americans is that the activity by U.S. financial institutions described below is not illegal. American financial institutions are facilitating investments worth billions of dollars in the People's Republic of China companies that advance the PRC's military ambitions and perpetrate the CCP's human rights abuses." In November 2024, over a dozen financial officers from 15 states sent a letter to public pension fund trustees, urging them to divest from China. They warned that under the CCP's cover, China's market lacks transparency, and failing to divest in time could lead to significant losses. The 18 financial officers from various states wrote in the letter, "Trustees of state funds have a duty to investigate investments and a duty to monitor investments and divest from imprudent investments in order to ensure that those funds grow and are protected for future beneficiaries. The time has come to divest from China." It continues, "Many fiduciaries, including state pension plans, failed to recognize similar warning signs before Russia's invasion of Ukraine in 2022. As a result, states lost billions of dollars in value that was held in trust for retirees. Pension boards should learn from the past, or they'll be doomed to repeat it." On April 9th this year, the U.S. House of Representatives Select Committee on the CCP and the Senate Special Committee on Aging held a joint hearing to discuss the threats posed by the Chinese Communist Party to American retirees' savings. The attendees focused particularly on the impact of rampant telecom fraud rings and unfair financial investment systems on U.S. pension security. While the government's warnings did not directly name Bridgewater Associates, the pressure on the firm was clear. This warning, issued in April, coincided precisely with the time Bridgewater had significantly increased its holdings in Chinese stocks. By August, another bombshell exploded in the U.S. financial sector. On August 4th, conservative political journalist Natalie Winters published an investigative report stating the CCP's decade-long infiltration has breached the Federal Reserve, coercing employees, stealing sensitive data, and threatening the core of America's financial system. The report noted that while most Americans have heard of CCP spies targeting the U.S. military or private enterprises, a lesser-known front is the CCP's long-term efforts to infiltrate and attempt to manipulate the Federal Reserve. The Federal Reserve has become the top target of CCP espionage activities. The report explained that the Federal Reserve is the engine of the U.S. economy, its decisions impacting markets, influencing global capital flows, and setting the tone for the world's monetary system. By infiltrating the Federal Reserve, the CCP not only gains intelligence, but also strengthens its influence. Winters argued that this is an economic war putting the U.S. into a national emergency. If the U.S. does not take action, it is essentially handing the keys to the global financial system over to the CCP. Professor Ye Yaoyuan from the University of St. Thomas stated that the CCP's purpose in infiltrating the Federal Reserve is essentially twofold. The first is to gain confidential information through intensive contact with officials. The second is to influence the direction of U.S. currency policies through cooperation and exchanges with these officials. He gave an example. Since China holds U.S. sovereign funds, if the CCP knows in advance when the U.S. will adjust interest rates, it could find ways to obtain higher returns on U.S. Treasury bonds or U.S. stocks. This would essentially be considered insider trading. Ye pointed out that by obtaining confidential information, the CCP would use this to counter the U.S. and engage in unequal competition. He stated that the chairman of the Federal Reserve also considers opinions from others when making decisions. The CCP attempts to control the decision of U.S. financial and currency markets through the officials it has infiltrated. Although the CCP is not yet capable of direct manipulation, this infiltration and influence will gradually accumulate, effectively affecting how the Federal Reserve formulates policy. Ye said that if the CCP manages to fully understand every decision made by the Fed, it will gain an advantage in the economic competition between the U.S. and China. He said, "This is truly an economic war." Mr. Z pointed out that the Federal Reserve, Wall Street, major U.S. banks, and tech giants all form a shared interest group, with deeply intertwined connections between them. In most parts of the world today, capital does not follow politics. On the contrary, politics serves capital. However, this time, the political goals of the U.S. and capital have once again aligned. The shockwaves in early August regarding the Federal Reserve and Dalio's departure may not be directly linked, but the important point is that Bridgewater's separation from Chinese capital now aligns with U.S. political goals. This is because the U.S. government and capital have reached a consensus. The CCP's totalitarianism is the greatest uncontrollable threat today, and the risks of investing in China have become unbearable. As one of the investors most familiar with China, Dalio's successful career came to a close with the final transaction of clearing out Chinese capital. This marks the real direction of China's future economy and is considered by him as the most correct investment decision of his life.